So I'll turn this back on. So what you do is every month you get a bank statement. Okay? This is what the bank statement looks like. Okay, this is an example of a bank statement. And what you have here now is your bank statement looks something like this. And by the way, it's kind of strange teaching a class like this because many of you have had checking accounts for decades, but let's just go through the steps to make sure, you know what I mean, make sure that everybody is up to speed, okay? So here we go. What it is, what it has is, here's your previous balance, total checks and debits, total deposits and credits, and your current balance, okay? Now, in this case, they have a $23. So if it says a debit memo, that means that your account went down. And where they come up with the debit memo, of course, is the fact that you have, from the bank statement point of view, your deposit is an accounts payable, right? So every time they debit your account, what they do is they lessen the amount that they owe you if you receive it. So this would be a debit memo. Every time you receive a credit memo, they credit your account so they owe you more money. Okay, so from a bank's point of view, your account is an accounts payable, because when you deposit $100 in the bank, they incur a debt, because it's your money, it's not theirs, so it goes with accounts payable. So if you receive it, if they debit that account, a debit memo, it will lessen it. In this case, the $23 is a charge for printing, or check printing charge. And if they have a credit memo, that means their accounts payable went up, they owe you more money. Okay, debit memo less, credit memo right. So, and the debit memo and the credit memo, in every case it describes what happened in the books of the sender. In this case it's the bank. Okay, so the debit, all right. Then you go down here, it goes to check number 123, 125, 127. So check 124 and 126 are both missing. Okay? NSF stands for non-sufficient funds. So what this means is somebody wrote you a check for $20. You deposited in good faith, and now you get this bank statement and they notify you that it bounced. Okay? And there was a $10 service charge for depositing a NSF check, even though it wasn't your check, right? Okay? Now, these are checks and debits. Over here they have deposits. So they have a $485 credit memo. So that means your account, that you got credited for $485. In this case, what it is one option you have there, like if you sell a house on a contract, what you do is you take that contract to your bank and say, listen, instead of sending the money to me, send it to my bank, right? And your bank will take the money, keep track of all that's been spent. Often they'll figure out the interest and all that. There's a charge for it, of course. In this particular instance, there was a $500 note. And in the $500 note, you hung it at your bank and said, don't send me the $500, send the bank the $500. And there was a $15 service charge for doing that. This particular account also pays interest. It paid $842. So this credit of $845 is a $500 note receivable and a $15 charge for processing it. $842 is the interest. Now, what you want to do in your bank reconciliation, it looks like this. Yeah, Jessica?
Where does the $15 show up on your bank statement?
It doesn't. It doesn't show up in the bank statement. It would show up in some sort of an agreement or, and I agree with you, it would be better if it were accounted for, if it showed up as a debit memo perhaps.
Right.
Yeah, but, because all they're doing is they're just putting the net here.
Okay.
And I agree with you. It would, in fact, the Clark paycheck, you know, this pay stub, it has all these net amounts, but you don't know what into them. And they might as well, don't bother to give it to me. It makes no sense. You know what I mean? Yeah, seriously.
Well, I was just thinking to myself, how did you know they took in a $500 payment? It only says $485, and I don't see $15 except for that check over there.
The check pay stub, the Clark check pay stub, does the same thing. It's all these net amounts. And I thought, don't bother to give me this thing. I don't care. Because for the same reason, it doesn't make any sense. What went into the net?
All right.
Yep.
Just checking.
I listen. You're preaching to the choir. All right. Couldn't agree with you more. Now let's go into bank reconciliation. So what you do here is you want to just make sure that all your cash is being accounted for. So what you do is when you get this, you do a bank reconciliation. So here's how you do a bank reconciliation. So a bank reconciliation, what you do now is you have the bank statement balance. All right, and in this case, if you look at the one we have on the board, the bank says you have $2,050 in your account. Okay, and of course, it's on the bank statement. Now, by the way, this bank statement is found on page 330 of your textbook. Okay, so if you're at home, look at page 330 of your textbook, and you'll see that the current balance is $2,050. You then take a look at your book balance. And the book balance, in this case, what we're talking about is we're talking about your check register. So you open up your check register, and your check register says you have $1,404.58. Okay? So your bank says you have this much money, your check register says you have a different amount. What you want to do is bring each current, and the current balance in each has to equal. So in this case, what we do, when you looked at, and so what you do is you looked at your check register and you found that you made a deposit that didn't make it to the bank in time to be included in your bank statement. So to bring it up to date, you have to add deposit in transit, and in this case there was $145 that's on its way to the bank, didn't make it in time. That gives you a subtotal of $21.95. Okay? And then you deduct. In this case, remember when I went down there were 2 checks that was missing, so they're outstanding checks. There was a check number 124, and it was for $150. There was a check number 126, and it was for $200. That meant there was, if you add them together, they equal $350. You subtract that from the total, and that means that if you update this thing, your adjusted bank balance is $1,845. Okay? So, again, let me kind of go through the process. What you do is you compare your bank statement to your check register, right? The things that are on your check register, but not in your bank statement, are then put in your bank statement to make it current. In this case, in your check register, it showed you made a deposit that didn't arrive to be in time to be included. It showed that you'd also written 2 checks that weren't included. To make it current, you have to add the deposit that's in transit, that's in the mail, subtract the checks that you've written but have not been cashed. You wrote Uncle Charlie this $150 check, and Uncle Charlie's sitting on it, it's in his wallet. Okay? So this is the current updated balance. Now, what sort of things are on your bank statement but not in your check register? In this case, again, there's that note. So you add note, and it was $500 less the $15 fee. So that's the $485. You add interest earned. And remember, the interest earned was $842. Okay, add those 2 together, and the total increases are $493.42. That gives you a subtotal of $1898.00. Okay? And again, both of these things were on the bank statement. They were not in your check register. Now you have to adjust your check register balance for those things. Does that make sense? Another way of saying it then, the source document will be your bank statement. Okay? Then you do your deductions. And in this case, there was a check printing charge. And that was $23. There was an NSF check plus fee for $30. Those two together equals $53. You subtract it, and it equals $1,845. Okay? That's your adjusted book balance. And the adjusted bank balance has to equal the adjusted book balance, and if they don't equal, then there's some error. There's an error. You erred. Okay, does that make sense? Now, a couple things here. Notice you always put the increases before the decreases so that you don't have any negative subtotals, just because, man, that would be, if you want to cause confusion, have a negative subtotal, right? So always increases first. The other thing that happens here, let me stop and think, what was I going to say? Oh yeah, the other thing about this is, what you're doing here is, your primary purpose is to make sure that your cash is accounted for, right? Because if you're going to have a theft problem, it's going to appear someplace in cash. Now the other thing that this does is, don't forget, your main way of finding an error is to do a trial balance. Again, it's much more powerful than you think, but will it catch everything? No. So there's ancillary checks. Remember we have the schedule of accounts receivable and the schedule of accounts payable. They were ancillary checks. This is another ancillary check to catch things that a trial balance won't catch. Okay, it's another ancillary check. All right. Now, you guys doing good? Okay. Okay. So, to kind of sum up on the bank reconciliation, I'll turn this around, let me sum up and then we'll do some practice. So here we have, so to sum up, don't forget, here's what you do. What you do is you find the balance in your check register. And you find the balance, and that's the name for that is the balance per books, right? And then you find the balance in your bank statement. And then you reconcile them. The way you reconcile them is you make each current. And the way you make each current is, some things are on the bank statement that are not in your check register, and some things in the check register that are not in your bank statement. And then the current balance in each, the adjusted book balance, the bank balance, have to equal. If they don't, then you know there's an error, and find it before you go on. So here we have the cash balance per bank. To make it current, you add deposits in transit, you subtract outstanding checks, and then you fix an error. So if the bank made an error, it will go on the bank part of it. So suppose what they did is, suppose somebody wrote a check, and instead of taking it out of their account, they take it out of your account. In that case, you'd have to add it back in to fix it. So whatever it takes to make it right, you put it here. Okay, in this case, they shouldn't have taken the money out of your account. Gives you the adjusted bank balance. Here we have the balance per book. So you start out with your check register balance, you add collections and interest, subtract uncollectible items, and fix any errors. And then the two adjusted balances have to equal. Does that sound good? All right. Let's do a little bit of practice. Why don't we do quick study 8-6, page 346. All right, let me put it up here. So here's 8-6, page 346. All right? Make it more readable. So what it says is the cruise company deposits all cash receipts on the day they're received, makes all cash payments by check. At the close of business on June 30th, 2011, the cash account shows a $11,352 debit balance, okay? By cash account, I've been calling that your check register. They call it the cash account. Cruise's June 30th bank statement shows $10,332, a different amount deposited in the bank. Prepare a bank reconciliation. So they start out by telling you what the outstanding checks are. Now, where do the outstanding checks go? The outstanding checks, of course, will be subtracted from the bank balance. And then there's a debit memorandum for bank services. So a debit memorandum means that your account goes down. They're going to debit your account. And so that goes on the book balance. Okay, this is on the check, okay. The bank statement show, no, here's a $90 check written by the cruise company. It was mistakenly recorded in your books. So the bank took out an extra check, that's the error. What do you do to make it right? And then June 30th cash receipts were placed in the bank's night depository but didn't make it to the bank statement, so you add deposits in transit. And there's $5 credit for interest earned. That will show up as interest here on the book part. So with that introduction, let me turn you guys loose. I'll turn on the light so you can read that in front of you more easily. Now I'm going to turn this light back off because it makes that report really easy to read, but you guys at home, be sure to just read your textbook in front of you. It'll be easier than working with this on the board. Put the out turning down. So you guys watch this at home. Serene looks like the cat of the canary. Ready for it? You think you got the, I bet you got the right answer. You want to see? Okay. Feedback sound good? All right. Okay, let me turn out that light so if you guys watch this at home, you'll have the feedback. Because that middle light puts glare and it makes it sound readable on that. Did I rush on that? I did. No. Okay. the notes and let's kind of review it. All right, you ready? Let's see. People are still taking notes. Let me give you guys just another minute and then let's kind of review it. All right, so here's what you did. You started out, bank statement balance. Your bank statement said you had this much cash. Then when you looked at your check register, you found that there was a deposit that didn't show up on the bank statement, so now you have to add it. And also you'd written a check for $1,713 that didn't show up either, so you got to subtract it. So this is the adjusted bank balance, is merely the current balance. Then over here, you have, where's that $99 check? Do I have the right one here? 86? Okay. So now,
999 is just 9.
just 9, okay.
No, it's just 9, it's right.
Oh, just 9, oh, you're right, I'm sorry, you're absolutely right, thank you. You guys, hey, listen, I'm glad I did that. So don't forget, in this case, and what I did is in this case, what it is I mistakenly misread it. But what the deal is,
Difference.
yeah, it's the difference. Whatever it takes to make it right, right? So in this case, you mistakenly put it in your check register as 99. You'd written the check for 90. There's a $9 difference. That's what it takes to make it right. And because you took out too much money, you put $9 back in. And what I did is I mistakenly read it, and I read it as so they took a check out of your statement that should not have been taken out of your statement. It's how I just quickly read it, you know. And in that case, it would show up on the bank side, and they would make it right. Yeah, okay, I just read it in a hurry. Does that make sense? Everybody doing good on that? All right. Then you take, here's what your check register says you had. You fix the error, interest earned, those are the two additions. Take away the service charge, the two adjusted balances are the same. You have a lot of assurances that your accounting was done correctly, it's okay to go on. Okay? You guys doing good? All right, and then, now by the way, sometimes an error can show up on the bank side, sometimes it'll be on the book side, whatever it takes to make it right. Sometimes it will be an addition, sometimes it'll be a subtraction, whatever, it can show up in any one of the four positions, whatever it takes to make it right. In this case, you need to add $9 back to your check register. All right, you guys doing good? All right, so, you're okay with that. Let me put this here. I'll put this here. Now let's go back to the original one, the one that I have, the one that I used as an illustration on the, for the board to walk you through this thing. You can also find this in page 332 of your textbook if it's easier to read. What you now need to do is you need to take all of the things, all of these, and I'll put this here. So you need to take all of the entries on the book side, and you need to journalize it. Okay, your your bank statement is the source document. So let's go through some of these. Danny, we'll see you next Tuesday.
Tuesday, yep.
Sounds good. So in the first one, as far as this note goes, this $485 note, here's how you journalize it. So what you're doing here now is you were notified of these things when you got the bank statement, and now you need to put them in your bookkeeping system. So in this case, you were notified on October 31. Okay. Cash will be debited for $485. Collection expense will be debited for 15. And then the $500 credit is a credit to notes receivable. Okay? And so that's the $500 note. And again, you are notified of it. All of these things have to be journalized. Your bank statement is the source document. Okay? All right. Now the next one, again on the 31st, this interest of $842, you have cash will be debited for $842, and interest revenue will be credited for $842. Okay. Now, this miscellaneous expense of $23, again, it's a check printing charge. And so, again, to kind of build on this point, if you had an account like banking expense, and they put this $23 in there, then when it came time to say, listen, how did I do this year? You can see that your bank is costing you 23 bucks, right? If you put in a miscellaneous, who knows? And you may say, listen, I'm paying too much for my bank, I've got to start shopping around, whatever, but you can't make good decisions. So, but in this case, what they do is they debit miscellaneous expense, and it's not a good idea, for the $23, and they credit cash for the $23. And then the NSF check. Now, what you do with an NSF check is because you're going to try to collect it, right? You're going to put it in accounts receivable. Now, if you can't collect it, you'll have to write it off as a bad debt expense, but that's later down the road, it's another step. But at this point in time, you're going to say, I'm going to do my best to collect this, so you put it in accounts receivable, and you put it in for the full 30 because they're responsible for the $10 service charge, and of course you credit cash for the $30. Okay? And so to sum up, what you do is all of these entrants in your, to adjust to bring your book statement current, have to be journalized. Your bank statement is the source document. You credit and debit cash accordingly. If you didn't do this, then your books would be off to that extent. Just, okay, does that make sense? Yeah, Jessica?
So, when you go to the grocery store or any place that still takes checks, they say that they're gonna charge you like $50 if you write them a bad check. Clearly, it's not costing them $50 for taking in the bad check. So, when you're doing this, would you put the AR as the amount of the check plus whatever you've stated your fee is?
Well, this is a little bit different. I hope I understand you correctly. What this says is the fact that when you got your bank statement told you there was, I'm going to find it here out. Let's see, where did I get that thing? When you did the bank statement, here it is. When you got the bank statement, $30 was taken out of your account. 20 for the NSF check, $10 for the goods, right? So when you then go after this person, you're going to have to go after them for 30. That's the amount they owe you at that point in time. So I think this is a little bit different than what you're describing. What you're saying is somebody wrote you a bad check, you deposited it, and they're notifying you that the $20 check bounced, but they're also telling you we're charging you $10 to process a bad check.
Right.
Okay.
But what if you say, if you go to the store where there's a little sticker that says, if you give me a bad check, it costs you the amount
Exactly.
and $25?
Right.
So, in this case, your bank is only charging you 10, they wrote you a $20 bad check, but you want to charge them 25 instead of the 10. Where do you put that?
That would be a
Or
revenue.
would that just be?
First of all, that would be revenue, and I don't declare the revenue until you earn it.
Okay.
So what it is, so what you're saying is now I'm going after these people, and I want a total of let's see, this is 30 plus 15, I want 45 bucks. And the 45 bucks will be $20 for the bad check, $10 for the service fee that I got net, and then $15 revenue.
Okay.
So what you do at this point in time, it'll be a $30 accounts receivable. Then when you collect it and earn the other $15, then that's when you declare the revenue. So when you collect it, you debit cash for $45, credit accounts receivable for 30, credit revenue, some sort of a revenue account for the amount that we are charged. And it would be a revenue account because you earned it. Yeah, and of course you wouldn't declare the revenue until you declare the revenue when you earn it. When you earn it. Okay. All right. So you guys, let's do this. Let's take a look at this exercise. Now, which one did we do? We did exercise 8.6. Okay. Let's do exercise 8.10. All right, so now what it does is, we already did 8.9, right? No.
We did 8.6.
8.6, that's right. All right. Let's take a look here. Let's study 8.5. Let's see if that is just a second. All right. Hey guys, do we really need any practice with this? You okay with it? What threw me off was I was going along, and I normally do. You know, when we did the bank reconciliation, I had instructions for me to do that, and then you guys would do an identical one. And I thought, no, these guys are getting this. There's no need to do this twice. So then you did the one that I was going to do as a demonstration. And then when you guys did, does that make sense? Yeah. And I thought, these guys are sharp. They got it. They don't need it to demonstrate. Yeah, seriously, and you did just fine. Okay. Does that make sense? So, all right. Now, you guys are okay with this? Anybody like to see it demonstrated? I'll be glad to. Okay, doing good? All right, sounds good. Let's go ahead and call that good. Okay. All right. So any questions, comments of any kind? Okay. All right. Let's do this then. Let's turn on the lights. We go on to some more topics. All right. Now, man, we're going gangbusters today. This is impressive. So let me turn this over to the other board because that one's getting full. And let's take a look at the time. We've got good, we're doing fine as far as time goes. Let me go ahead and go on to the next. Okay. So now, the ratio in this chapter is days sales uncollected. And in this case, you take your accounts receivable and you divide it by net sales and you multiply that times 365. Okay? And that will give you the days sales uncollected. Now, what this tells you, this is, some of these are an average, some aren't. This is not an average. It takes a look at your the financial statements at the end of the accounting period. This comes off the balance sheet. This comes off the income statement. And then this will give you, at this point in time, multiply times 365 to give you the number of days, right? Now, what this is the fact that if you were going to invest in a company, you want to know, are they keeping on top of their accounts receivable? Now, what happens here is the fact that whether this is good or bad depends on how you want to do business. So, for instance, what happens in this thing is some businesses, what they do is I'll go over here so I can be in there. So what some businesses do is they say, listen, we only lend money to people we trust. We're in a small town, we go back a long ways. Okay, and so I lend the money, if you expect to be paid in 30 days, I'm paid in 30 days, okay? Other people have a different philosophy. So for instance, when I was back in Denver, one of my neighbors went to buy a mattress. And it was one of those where there's no payment or interest for a year, right? And it was a good deal of a mattress. So he went down and tried to buy it. They ran a credit check on the guy, and they came back and said, your credit's too good. We don't want your business. told him that. He was up in arms. He said, "This is un-American." Well, it turns out what the deal is, it was a good deal of mattress. There was no principal or interest for a year, but if he ever got behind, then they'd go back and charge him for the interest for that year. And they could only lend to people who they expected to get behind. Yeah, they told him this.
That's hilarious.
Yeah, so the point of the matter is, whether the days you have uncollected is good or bad, one of the factors is how you do business. If you do business such that I lend money, I only lend to honest customers, I'm not interested in any BS, I expect, then, you know, if this comes out to be 45, 30, that's bad. Other people have a liberal policy, hope their customers do get behind and make their money on the interest and the penalties. And in that case, yeah, and the guy was, and by the way, he raised the stink, but it was stuck. It was perfectly legal. And they told him, "We don't want your business, your credit's too good." Yeah.
Taking advantage of the irresponsible, I guess you could
Yeah.
say.
Mm-hmm.
There's money to be made off those people.
Yeah. But again, I don't, you know, it's a way of doing business. And when I tell a story like this, I'm hoping to make it, I'm hoping I enable you guys to remember the ratio. Because the object of this whole thing is to, you know, to make the ratio memorable. It's not to advocate a good or bad system. Just like when I suggested putting the $2 in your pocket, you can't, I'm kidding, don't do it. And whatever you do, when you take the next accounting, don't tell that next accounting instructor I told you that either. That's really important. So I'm kidding, but I'm just trying to make it, all I'm trying to do is make it memorable, right? And I was hoping a story like that would make this memorable. Okay? All right. You guys, let's do this. Let's kind of move on here just a bit. Now, the next thing this chapter gets into is internal control system. So when you have an internal control system, you know, I have to be kind of careful, because, you know, I was kidding about putting that $2 in your pocket. But what happens when it's on tape? It's a joke, right? But I know when these things are on tape, I have to be careful in the stories that I tell. Because I'm just trying to help you guys learn this stuff, right? But I don't want this to come back and bite me.
No, you've got four
Totally be
disclaimers
taken
in
out of
there already.
context now.
Well, yeah, I'm saving this one, but I've told other stories that
I think you're safe, but what if I take it and edit it now and
Yeah,
save that?
exactly.
Once you post it online, it's got a tracking record.
It's exactly right.
You can find alterations that somebody might have done, because they'll do the tracking record.
Yeah, okay, well, that's good to
So
know.
you're safe.
Well, I'm still going to clean up my stories, only stories that are ethical.
These are the real tricks to accounting, right?
You guys, anyway, listen, you set up these, what's that?
Bean counter for the mafia.
Yeah, it's true. You set up internal control systems. The reason what you want to do is and we'll get into how they work in a minute, but the object of the whole thing is to protect your assets, okay? You ensure reliable accounting. You promote efficient operations. And you urge adherence to company policies. And I'm going to abbreviate company as CO. Now, the Sarbanes-Oxley Act, okay? These are both congressmen. What the deal is what's happened here is we had, they're a while back now, but there were a whole bunch of spectacular failings of the accounting system. So when these things occurred, whenever these things occur, everybody is to be in their bonnet, hang them high, they have a big witch hunt and all that. And then it doesn't take long before everybody just goes back to business as usual. They don't have time to mess with this. What's different about the Sarbanes-Oxley is that it isn't going away and that it has real teeth, and it may stick around. And basically what it says is that CEOs and CFOs need to document and certify the system of internal controls, okay? So it requires managers document, okay, and certify, document and certify internal controls. Okay, and what came out of this was some of the CEOs would say, I had no idea this was going on in my company. My accountant lied to me. Well, that no longer works. That if there turns out to be fraud within the company, the CEO and the CFO can go to jail. So it has real penalties, it has real teeth, and it hasn't gone away. So this may be different in that it may stick around and actually do some goods. Do some good. Now let's get into the principle of internal control. Some of the principles that are involved in this. Okay, I think I'll put it under here. Now, I be in anybody's way to take a note, should I? Okay. So, you establish responsibility. So these are control principles. Okay, you establish responsibilities. So an example of where this could be violated, I bet you all of us have have gone to a restaurant that had more than one server. And then when you went to pay, you paid your server, and your server opened the cash register, took care of, collecting for your bill, closed it, and the next server came out to collect it for their customer. That violates this principle. You want to have one person, and that person checks out what's called a change drawer at the beginning of the shift, which is just some money to make change with, right? They then do the business throughout the day, and they check it back in. They take out the change, put it in the bank the next day, and then they compare the cash to the cash register tape, and one person's responsible. And if you have more than one person with access to that, money's gone, who do you blame? Okay? Be sure to always maintain adequate records. So an example here is the fact that the problem you have is that what you want to do is you want to set a good example. So if you own a store, Christmas time comes around and you take a gift home for one of your family. Take it off the shelf, sign it out as everybody else does, require everybody to sign these things out so that everything is accounted for. Okay? Insure assets and bond employees. So, bonding, what that is that's an insurance policy. And what it is the bonding company will reimburse you if any of your employees embezzle, right? You buy an insurance policy. Now, it has a couple of advantages. Number one, when you advertise for the job, you state must be bondable. And that just means that a whole bunch of people who have a criminal record can't apply because they won't be bondable. So it does some filtering there. The other thing that it does, if one of your employees steals from you, you can certainly prosecute, but a lot of times it's bad publicity, ties up a lot of your time, and you're unlikely to get anything for it. So often what businesses do is they just go back to work and just write it off as a bad experience. Bonding companies don't do that. What they do, because they want a reputation for being really hard-nosed, is they hunt these people down to the ends of the earth and they prosecute to the full extent of the law, because they want to say, don't mess with us, right? So, bond your employees that handle cash is an insurance policy. It shifts the risks, it does some filtering, and it tends to keep everybody a little bit honest, because these guys want a bad reputation for being bad to deal with. Okay? Separate record keeping from custodian of assets. So separate record keeping from custody of assets. So what this means is one person writes the check, a different person does the bank reconciliation. Okay, so the custodian of the assets, the guy who writes the check. The person who does the reconciliation, the bank reconciliation, is the record keeper. Make sure these are two different people. And what it is again, these two can embezzle, but now they can't do it alone. They have to get the other person to collude, and it's just tougher to do. Okay, there's no guarantees, but it just makes it tougher to do. Divide responsibilities. So what it means is no one person should do a process from beginning to end. So for instance, a friend of mine had a really small business and had one bookkeeper. And this one bookkeeper really did have to do everything from beginning to end because there was one of them, right? But what this guy did is he had all his mail sent to a mailbox. And on the way to work, he'd take out all the mail, he'd open up all the envelopes, take out the paper, put them back in. Often he had no idea what they meant. But he felt that did a lot to keep the bookkeeper honest because the bookkeeper didn't know what the guy did with them, whether he was keeping track, calling, or what. And that's the only way he could divide up the responsibilities, is he just collected the mail. And because there was one bookkeeper, there was no other division of labor to be had. Applied technology controls. So for instance, if you're in QuickBooks, everybody who enters QuickBooks has a code, but that code will only let them into parts. So one person can get into receivables, another person can get into payable, and only one person, the administrator, has access to the whole account. So QuickBooks has a password, and the passwords will only let you get into part of it. The administrator has a password that will let that person into the whole thing, but they're the only one that has that password. Everybody else just is. So there's technology controls. And perform regular and independent reviews. So, what you want to do, so for instance, what happens on this thing is the night shift, for example, often feels alienated. They don't feel like they're really part of the company. They just show up, do their business, go home. And often if you're going to have a problem, it'll be the night shift. So one of the things you can do is show up unannounced, do some sort of a review, because that's often where you can make it count. Because they just don't feel part of the company. They don't feel the loyalty that other people do because they show up, go home, nobody seems to notice. Yeah?
I have to disagree.
That's fine, as long as it makes a memorable story.
Well, for me, it's my job to make sure that everyone else is honest because I like my job.
Okay.
I like the company that I work for, and my job is to count the money and make sure that everybody else counted their part correctly.
Mm-hmm.
And I have caught 4 people to date who stole money from the company. So, I don't know, maybe other night people just show
But
up.
not you, well, that makes sense, sure.
But for me, I like my job and what it offers me, so
Okay, sure.
I have to disagree.
Well, and yeah, sure, it makes sense, but a lot of times the night shift, they show up, do their job, go home, nobody seems to notice. So often they just don't have that loyalty or whatever, they feel a bit,
Well, like she said, she caught 4 people stealing, night shift.
Yeah.
Yeah. I don't do it. Everyone around me does, but not me.
They were actually day shift
So here we
employees
go.
that
Oh,
were stealing.
okay.
I audit,
Mhm.
so